Hey everyone, welcome to Deal Worth It. Today I'm going to be using the silver edition of Deal Worth It to quickly analyze two deals. The first deal I'm going to analyze is a 246 unit property in South Carolina. The asking price on that property is $50 million. The second deal I'm going to be analyzing is a 20 unit here in Milwaukee. The asking price on that is $4 million. With Deal Worth It, you can analyze deals of all different sizes and all different markets. So let's jump into it. We'll start with deal number one. I'm going to paste the address right in there. What DealWorthIt does is it actually pulls the property data up. If it's unable to pull up property data, you can still go ahead and proceed. This just makes it a little bit easier right up front. So we see this deal is 246 units. We're going to underwrite it at 95% occupancy, just like the bank would. The average rent, according to this offering memorandum, is $1,550 a month. They don't have commercial rent, so we're going to move on to other income. Other income on a property like this is anywhere from 5 to 10%. We're going to be conservative. We'll do maybe $18,000 of other income on this property. This is other income per month. Now, this is pet fees, this is valet trash, this is garage rent, this parking income, all of the other income, laundry, anything that the property generates other income-wise, we're going to say that this property generates an additional $18,000 per month of income. Now we can underwrite the deal using three different avenues. We can take the cap rate and operating expenses, the purchase price and the operating expenses, or the purchase price and the cap rate. On this property, we know that the purchase price and the operating expenses based strictly on the offering memorandum. So I'm going to go with a $50 million purchase price, as that's what they're asking for the property. And their expense ratio is right around 35%, but for us, we're going to underwrite it around 40% just to be conservative on this deal because taxes and insurance will go up. In fact, I'm actually going to leave it at 45%. So now that you've entered that information, over here on the right side, you'll see the overall deal metrics. The purchase price, the required equity down, what our NOI is, our net operating income. And if you hover over each one of these bubbles, it'll actually tell you where these calculations came from, which is really nice if you're new to underwriting because you may not know exactly what all of these terms mean. This is a very important metric right here, the debt service coverage ratio. The bank will not give you a loan unless you exceed a certain ratio. So right away we know that this deal, as is underwritten, will not meet that ratio. But let's go through and enter the rest of the metrics. Make this deal make sense. So I'm going to start with entering some concessions and delinquency. I always go with about 3%. I think that's a very conservative number. This property was built in 2016, as we can see down here from the market data, so it likely doesn't need many capital expenditures. I'm still going to budget about $1,500 per unit, which adds $369,000 to our CapEx, to our capital expenditures budget, which, if you noticed, has now increased our required equity because this is non-financed CapEx. This is just extra capital we would raise in order to purchase this property and have some reserves to renovate it. One of the things you'll notice here is the cap rate. Right away, it's 4.88%. And if you're in the commercial real estate market today, you know that that is a very low cap rate, especially with interest rates hovering in that 5% range. So you can go through and see our cap rate, our total rental income, our gross operating income, our net operating income, our price per door, and our average unit income. So average unit income is about $1,500 per month. Included in that is our vacancy loss. So now we'll go over to the acquisition. As we can see, we don't meet that debt service coverage ratio, so we're going to have to increase our down payment. I'm going to go with 35%, which would give us 65% loan to value, which is a much more accurate projection based on today's interest rates and lending parameters. We can go down and we can adjust the closing costs. I'm going to keep it at 3%. I think that's very safe. You can see our loan amount is $32.5 million on this asset. Now what we're going to do is we're going to calculate our current interest rate, and that's going to be based on either the SOFR rate, the 5-year, 7-year, 10-year treasury rate. So if you bought a value add deal, say this was a Class C asset, maybe built in 1970 instead of 2016, and it needed a lot more capital expenditures to increase those rents, you would use a SOFR rate because you're going to get a bridge loan. The bridge loan is going to be the SOFR rate. The SOFR rate plus a spread. The lender will add a spread on top of that. And with a deal like that, you would likely need to purchase a rate cap so that your rate was fixed at least at a certain level that it would not exceed. And that would be something that you would add down here in the closing reserves, is you would add in that additional cost for the rate cap. For example, on our last acquisition in this price range, we paid over $1 million just for a rate cap, so our SOFR rate would not jump above 3. Luckily, we did that because now if you look, the SOFR rate is 5.31. So our rate with our rate cap insurance is locked at 3 until the end of next year. But anyway, back to this deal. This deal we would likely get some permanent financing on. We would go with let's go with the 5-year. Let's go with the 5-year Treasury rate, assuming that we're going to refinance this loan, hopefully when interest rates come back. So as we can see, the 5-year Treasury is 4.6%. We're going to add a spread on top of that. The lender's going to add 1.5 to 3 points on it. I would add probably about 1.5 to this, and that's because we would do some sort of spread buy down from the lender, and that'll cost in the range of about $250,000 depending on the loan size, but we'll just be conservative and add in about $250,000 in our closing reserves after. But right now I'm going to take the rate 4.6 plus 1.5 is 6.1%. That makes our all-in rate 6.1%. It would come with likely around 24 to 36 months of interest only. So with the interest only, we are getting closer to a debt service coverage ratio that the bank would accept. Our monthly mortgage payment interest only is $165,000, and our monthly mortgage payment when the interest only period expires is $200,000. So like I mentioned earlier, we will be adding a closing reserve to this. I'm going to say there's $250,000 just for the rate cap. They're likely going to make you escrow some taxes and insurance. I'm going to just put in a ballpark number of about $500,000. That'll give us a nice buffer, and if we do not use that money at closing, we will then use some of that cash throughout in case cash flow does not cover the actual mortgage payment. So when we go up here, we can see our loan amortization schedule. We can see we have all these interest-only payments for 2 years, and then we go down as we go up to year 30. I mean, we can break it down here. Our interest payments, our principal payment, or our total payment, and the loan balance. As you can see in year 3, our principal starts to kick in, our loan payment goes up, and our loan balance starts to go down because we are now paying down the principal on that loan. So what we're going to do is we're going to go into the future tab, and in the future tab we're going to go with the appreciation rate of about 3% on the income, 3% on the inflation on the income, appreciation rate for the asset 3%, income inflation we're going to leave it around 3%, expense inflation we can keep at 3%, and the same with the vacancy rate, we'll leave it at 5% because that's a conservative underwriting model. So now what would happen is we'd likely try to get out of this property. We'd want to refinance it maybe year 5, depending on what's going on with the market. We know that they're asking cap rates about 4.8, but to be conservative, I know that in this area the cap rates on an asset like this are around 5.25 to 5.5, but we'll stick with 5.5 because in 5 years the asset will be a little bit older. The refinance interest rate, I'm going to actually leave this at 5%. I believe with a new loan we would get a lower interest rate, and 5% is a pretty good figure for a projection 5 years down the line. I think it may be lower than this, but we'll leave it at 5 to be conservative. We'll go with a 30-year amortization, 70% loan to value, and I believe that we would get another interest-only period on that new loan, about 24%, and this is going to cost us anywhere in the range of 2.5 to 3% of refinance costs. So let's type that in, and we open this box now. When this is no refinance, the box does not appear, but when you do refi, this will show up. So we can see our net operating income in year 5 is going to be $2.7 million. The appraised value of $50 million. Our refinance loan is $35 million. Refinance cost $1.5 million. Repaying our existing loan of $31 million gives us about $2 million. So we started with a capital account balance of 19 million and we ended with that capital account balance around 17 million. That's not a great refi proceeds. The only reason we would actually refinance at that rate is to either lock in some new interest only period, lock in a lower rate, or if we needed to and our debt was becoming due, we would refinance in this situation. We usually try to return anywhere from 30 to 50% plus of our member capital when we are in a refinance situation. But at this point, we're just going to go with it and say this is mainly for the rate and term refi. We're going to sell this property at the end of year 10. It's going to cost us about 3% on the sales cost. Our exit cap rate, since we refinanced at the 5.5 rate, I'd like to exit around the same rate. We can even push this up a little bit, say it's a 5.75, just to adjust for possible inflation in there. And I'm going to say that we used about 50% of our reserves. So what we'll see now is what we would actually profit from this deal. So we see our NOI in year 10, our cap rate at the sale, our remaining reserves, and our sale price. We're taking out the sale cost, our outstanding loan balance, and we end up with $22 million of equity. By the time that we repay the capital account balance of $17.5 million, there's about $3 million left after that sale. So not really a great return on that asset. That gets broken down more in this section, but we'll go through the income and expenses. As you can see, our rent increases. Here's the in place as is when you buy it. Here is the end of year 1 after that inflation takes place on both the appreciation of the asset, the income, and the expenses. So our other income stays consistent throughout, and our income increases as we go along. Our operating expenses also increase based on the rate we put in, showing our NOI slightly increasing as we go up with this property. Down here in the income analysis, we show the NOI minus the mortgage payments to show you what cash flow is remaining for distribution. So we can see that this really isn't the best cap rate at purchase price. Here's our capital account balance showing our down payment, closing cost, non-finance capex, and the additional $500,000 reserve we threw in there, giving us a really, really low cash on cash return. The return on our equity is also really low on this. Honestly, this doesn't look like a great deal just because we know some of the property metrics. If we look at here, how much cash can we actually pull out on the refi? I mean, we're negative. We're negative a couple of years on this loan analysis. So honestly, yeah, look at this. This deal is losing money every year. Not a good deal at all. But if you were to buy it at that rate, we kind of knew that right away with the low debt service coverage ratio. So what we're going to do is we would upload some deal notes, like does not meet DSCR. You can save that note. We can put that in there so our team, if you have a team account, can actually go in and look at that. We can upload our offering memorandum and offering docs and everything else that goes along with this asset. And one of the other things we can do, which is pretty nice, is check out the market trends. So it looks like the market trends, the annual change in the area is actually decreasing. Other neighborhoods, I don't usually check the studios. I usually look at 1 and 2 bedroom trends. It looks like the east side is doing really well as far as annual rental changes go. You can kind of scroll through the markets and see what's going on in the neighborhood around your asset. Here's some similar properties in the area. Again, you can open up the details on each one of these. I'm not going to jump into that. Here's our deal right here. But you can see there's plenty of other comps in the area that you can start comparing your property to and getting that additional information. One of the things we're going to do is check what's going on in the proximity. So we can see supermarket-wise, Whole Foods half a mile away. It's right here on the map. That is a great indicator that this is likely a good buy. Whole Foods and other retailers, other high-end, big, expensive companies, they go in and they spend all of this money on market research. They spend millions of dollars on market research. So one of the things that you can do as a multifamily investor is kind of piggyback off of their research. We see it's extremely close to a Whole Foods. It's extremely close to a Trader Joe's. It seems like this side of the highway has some of the cheaper stores, the Hobby Lobby, the Walmart Supercenter. So likely on this side of the highway, we're gonna find a little bit better assets. Now, I don't know this area, but that's just my guess based on which one of these, retailers is in this certain proximity to our asset here. We can see the universities around, bus stations, shopping malls. There's a mall really close, hospitals within a couple miles. All information that you can find out about the neighborhood specifically. And then we have the demographic data. So we know on this property, our rent is about $1,550. So if you were looking for maybe the rent to income ratio, you would take your $1,550, you would multiply that by 12 to get about 18,600 and divide that by the 68,487. And what we can see is there's about a 27% rent to income ratio on this property. Ideally, you're in the 20 to 30% range, so we fall right within that window. But this property, unfortunately, is not going to work with these numbers. So, what numbers does it work at? Now let's go with offer 1. So, I'm going to clone this scenario right now, and we're going to restart back at the beginning and see what we can change on this property. So, as we can see, $50 million doesn't work. We're not going to pick up a property at a 4.8 cap, especially in this market. I'm going to give this property a haircut, and let's say it's a $45 million property. $45 million property now gets us into a much better cap rate. I can also probably reduce these expenses to about 42%. Still staying conservative. Usually Class A assets are doing much better than the 42% expense ratio. We operate ours down in Savannah, Georgia at about a 30 to 35% expense ratio. Class A asset built in the same year. Ours is 320 units compared to 246, but we know the expense ratios are about the same. So what we did now is we can see that this property certainly meets the debt service coverage ratio, and it has for Class A, that's a pretty good cash on cash return. We like to be anywhere from 4 to 6%, so that's a really, really good cash on cash return for this sort of asset. Now, we're not really going to adjust anything else here. Again, we're going to keep that at $1,500 a unit just in case it needs any additional info, any additional renovations. Based on this debt service coverage ratio, we might even be able to put less down. Let's see what this looks like at 30%. So at 30% down, which saves us a little bit money out of pocket, we are above 1.3. We probably want to be in the 1.35 with today's loans. We may be able to buy down a little bit more on this loan. So I'm going to add a little bit more money into that to see if we can maybe bring this rate down to 5.9%, which will make a pretty nice impact on our bottom line there. As you can see, we've now over 1.35 on the debt service coverage ratio. We added a little bit in here just to adjust for that closing reserve. I'm actually looking at a loan statement right now, and we had full term on a 5-year, interest only. I'm still going to run it at 36 months instead of 24. That's going to affect our cash flow pretty significantly. Let's do some other projections. Appreciation rate, 3%. Income inflation, still going to leave that at 3%. The expense inflation, though, as we buy these properties, we try to reduce the expenses. So we're going to drop that by about 0.5 point, and we're going to be at 2.5% on the expense inflation. Vacancy rate staying strong at 5%. This is a 97% occupied property. 5% is still conservative. Instead of refinancing at the 5th year, let's refinance in the 4th year, so we're only paying 1 year of that principal and interest. We're still going to stick with that 5.5 cap rate. That is the cap rate that these properties are trading at. We see our refi interest, our loan term. If we want to be conservative, we can amortize this over 25 years. I generally am getting quotes at 30, but let's stick with 25 just to be a little bit more conservative. We're going to add another interest-only period to that. I'm going to extend it to 36 months. But what I'm going to do is I'm going to lower this loan to value to 65 and see what that does for us. Again, the only reason we would be refinancing this property is for the rate and term. As we can see, the rate is dropped. We're using 5%, so it's a little bit better than the current loan. We are returning only about $1 million of our member capital, which isn't honestly that great, but if it locks us into another 3 years of interest only, that's going to allow us to cash flow a little bit more on this property. Sales, we're going to keep this exactly the same. I'm going to estimate that the cap rate is going to inflate towards the end of the life cycle of this deal, so we're at 5.75 instead of 5.5. And we'll go through the projections and see how this property looks now. As we can see here, we're getting 4 to 5% cash on cash. When we refi, we start to get to 7 and 8%. When the interest only, you can tell it expires because our cash on cash drops by almost 5%. Let's go to the loan analysis. Not a lot of money in the refi. Obviously, we kind of knew that because we're not forcing the appreciation on this. If you wanted to show forced appreciation, what you would do is actually use the full underwriting version. What we're doing now is just a quick analysis on a deal to show you exactly what you can expect when you're underwriting these deals quickly before you would actually move into the full underwriting model. This deal looks like it's going to return a pretty decent amount, so what we're actually going to do now is I would then proceed with this deal further. I'm going to compare the scenarios. Looking here, we can see we've reduced our operating expenses a little. Our cap rates increased significantly to more of a market level. We know that we're only going to be able to offer about $45 million on this property. The 50 was a little out of the range. We may even be able to do better, say 47, 48. We can adjust that as we go. But for the sake of this video, I'm just going to show you that you can compare these scenarios back and forth, and you can continue to clone it. So if you want, you can now take, offer 2, and you can clone the offer 1 scenario, and now you have offer 2. And offer 2, you can get a little bit, more conservative or less conservative. Say with offer 2, we're going to refinance on the 3rd year. We're not going to pay down any of that debt throughout the life cycle of this property. We're not going to return much, but we're going to keep this interest-only ball rolling. You could say this, we locked in another 10-year, and we're going to have 5 years of interest only on this loan. Our refi cap rate, pretend the cap rates are decreasing in this area, which now increases the value of the asset. Same loan to value, same refi cost. I'm going to project something here a little bit crazy. We'll go 4.5% for that refi interest rate. And we'll go down when we sell this property. Let's say the cap rates continue to compress, and now we're at 5.25. And our reserves remaining, since we had such good cash flow, we got about 80% of our reserves from the initial still in that escrow account. So we can go down and see, scroll to the bottom for quick here. You can see we've almost 2x'd our initial investment on these projections. Now that we've shown you what you can do with DealWorthIt, the multiple different projections on a large deal, let's go with a smaller deal. So this is actually a neighboring property to me. It's 2030 North Oakland in Milwaukee. Here's the property. It's 20 units. The average rent in that building is about $14.50. The average other income, I'm just going to estimate based on parking, laundry, similar things in my building next door to it, that we're at about $1,500 a month of other income. Now this is a small deal, so we're going to go through and see exactly what this looks like. I know the purchase price of this. They're asking $4 million. I know the operating expenses on an asset like this is going to be around that 45 to 50%, so I'm just going to leave it at 45, and we're going to analyze this deal. Oofa. As we can see, it does not meet that debt service coverage number. Again, I'm going to add in probably 3% for the delinquency. The units would probably need about, let's go with $3,500 of CapEx per unit. It's only 20 units, so $70,000 of renovation. If we want, we could add more to that, but I don't think there's a need to. In our acquisition, we're probably going to need over 35% down. We're finally getting into there. Still no cash on cash return. But as we can see, when we go in here and we add in the treasury rate, We're probably going to be at what, 649 on a smaller asset like this. It'll add a 2-point spread to it. 1.9. I did 1.9. It's close enough. Interest only period. They'd give us a small interest only period, but nothing like you would on those larger assets. We're still not very close on the projection there. Let's see if we refi in the third year. The cap rate's here about 5.5. Sorry about that. 5.5. Thank you. Refi interest rate. We're going to go with conservatively 5%, 3 years down the line. LTV 70. Another small interest only period. This is going to cost us about 3% on the refi. And sell this property. Let's go with a 7-year hold on it. We're going to use probably 50% of our reserves. And there we go. This property is not going to make us anything. I kind of knew that right away. I forgot to throw a reserve here. 150,000. So as we can see, at this $4 million mark, they're asking about a 4.5 cap. These are based pretty accurately with their asking price and their numbers. So I'm going to clone this to do an offer. Now you can name these whatever you want. I'm just going to go with offer 1. I know on this property we're not going to be able to pay $4 million. This is probably worth in the 3.3 range. So let's throw in 3.3 and see how we do there. Oh, look at that. Right around 3.3 is what we should be looking at. That's 35% down. 30 years, 649. Maybe we buy this rate down. 10 year, maybe we only add 1.5. So let's go 6.19. It's probably going to cost us another 100 grand. It's probably going to cost us less than 100 grand. Just trying to go quick through this. Interest only period for 12 months. Monthly is 13,000. So this deal, we've reached a debt service coverage ratio that makes sense. We're going to go in, and I'm not going to mess too much with this. I know 5.5 and exit cap. I'm still going to stick with 5.5. Let's see if this deal's worth even pursuing. Just because it meets the debt service coverage ratio doesn't mean that it's going to be a great investment unless the area is appreciating significantly, which this area is, but we would evaluate that further on the deep dive underwriting. Well, as you can see, we're making about 50% on our money. Not a great property here, to be honest with you. The cash flow, about 50 grand a year. We have pretty low cash on cash throughout the property, so this isn't a deal that we would likely look at further, even at the 3.3 million mark, unless we were able to get those average monthly rents well above that 1,450 mark. If we are now going to have market rents of 1,550, say we're able to raise it $100, that's going to affect the numbers enough that it may make this deal worth it. So look at the future projections again, see what it's cash flowing. Our cash on cash, still 4%, so still not a great deal. This is more of a park your money equity play, I would say, than further deep diving on it. These 20 unit deals, if they're easy to buy, one of the things you have to know about multifamily real estate, if it's easy to buy, it's usually hard to sell. It's a 6 cap property. The problem is honestly the debt service. Even buying the rate down, I mean, our interest rate here, as you can see on the purchase of this property, our interest rate is 6.19, our cap rate is 6.18. When it's that close, there's just really not a lot of meat left on the bone. Now, say something drastic happens in this market, what's going to happen is, say when we refinance, this becomes a 5 cap market, and when we go to sell, we're still at that 5 cap market. Now, this isn't an unlikely scenario. This is honestly what happened a few years ago when people were buying properties in the 3.5 and 4 cap range. So looking at projections, that's raising the rent and kind of anticipating compression on the cap rates. We can see our cash on cash, like I said, still low, but it is cash flowing day one. And what would our sale proceeds be? So we'd about double our money on this. So not a horrible deal. Just, there's better deals out there. So this would just be a park it play unless you can have some significant value add and refi out of it somewhere down the line. So out of both of these deals, I would likely further underwrite this deal, pending when we talk to the broker that we're able to kind of get in that $45 million range. If we're starting to get in the $45 million range, what I would do is then convert this over to a full underwriting, and I will show you that in another video. If you have any questions on the quick underwriting tool, feel free to reach out to us, Jesse at DealWorthIt.com, Daniel at DealWorthIt.com. You can use the chat bot right here in the corner if you have any questions right away on how to use the tool. Another thing you can do is hit this quick tour button. The quick tour button kind of shows you everything that's going on, where you're analyzing deals, different things like that. And if you have any feedback, so if you find something that's not quite right with the tool, you have a suggestion, or you just want to give us a compliment, please use this provide feedback button. The only way these tools continue to evolve if we get this feedback from you guys. So we really would appreciate any sort of feedback that you have on the tool, and if we can help you in any way, please feel free to reach out to us anytime. I hope you all have a fantastic day, and thank you for your time.